If you claimed Social Security before 67, your tax return this year may be hiding a mistake that cost you thousands, and most early claimers do not find out until they are already staring at a bill they never saw coming. Here is what changes the moment you claim early that almost nobody warns you about ahead of time. You locked in a permanently reduced benefit, which is the part most people do know. But the part they do not know is that this reduced benefit still gets counted in the combined income formula the IRS uses to decide how much of your Social Security is taxable. Combined income is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit for the year. The fact that your benefit was reduced for claiming early does not change how the formula works. A smaller check still gets run through the exact same calculation as a full check would, which means the IRS can still push up to 85% of it into your taxable income depending on what else is on your return. The thresholds that decide this have never been adjusted for inflation since they were written into law, which means more retirees cross them every single year even without changing their spending or lifestyle in any way. There are four specific things early claimers need to check before they file taxes, and the first one is what financial planners call the tax torpedo, because that is exactly what it feels like when it hits. Here is how it works in plain terms. If you are sitting below the $25,000 combined income threshold, none of your Social Security is taxable. The moment you pull money from a traditional IRA or 401k to cover expenses, that withdrawal counts as ordinary income, jumps directly into your combined income number, and can instantly push 50% or 85% of your Social Security into taxable territory at the same time. A single $30,000 IRA withdrawal can flip a $0 tax bill on your Social Security into a situation where you suddenly owe several $1,000s more than you expected because you are being taxed on the withdrawal itself and on the Social Security income it dragged along with it. One published analysis of this scenario for a single filer over 65 using 2026 numbers found a federal tax bill of roughly $5,260 on a $30,000 IRA withdrawal, an effective rate of nearly 18% on a withdrawal that technically fell inside the 12% bracket. The reason for that gap is the torpedo. Every extra dollar you pull from a traditional account does not just get taxed once. It pulls 85 cents of Social Security into the taxable pile alongside it, and both of those amounts get taxed together. Some analysts describe this as a real marginal tax rate of around 22% for retirees in the 12% bracket, even though their stated bracket says 12. The second thing to check is whether your tax withholding has been keeping up. When you claimed Social Security, you had the option to elect voluntary withholding using Form W-4V. Most people either skipped this entirely or set a flat percentage, typically 10%, without accounting for how their other income sources would interact with the benefit. Early claimers especially tend to underestimate this because they locked in a smaller check and assumed a smaller tax liability would follow. But combined income does not care how large your check is. If you are drawing from a pension, an IRA, and a part-time job on top of a reduced Social Security benefit, the IRS looks at the whole picture together, and that whole picture may have already pushed you into a much higher taxable tier without any quarterly payments or withholding elections to cover it. This is one of the most common reasons early claimers get surprised by a tax balance due in the spring, because they were comparing their withholding to their Social Security income in isolation, rather than to the combined income number that the IRS actually uses to calculate their bill. If this is helping you catch something before it becomes a problem, go ahead and subscribe now, because the next two things early claimers need to check before they file are the ones most people miss entirely, and one of them involves a credit that quietly vanishes if your income crosses the wrong line. The third thing to check is the earnings test and whether you are working in any part of this tax year before you reached full retirement age. If you earned wages above $24,480 in 2026 while collecting benefits below full retirement age, the SSA withheld $1 for every $2 you earned over that line. That withholding was reported to you, but what often does not get communicated clearly is that it affects how much of your Social Security income appears on your SSA 1099 form for the year. The amount shown on that form is what actually gets used in the combined income formula. If the SSA withheld several months of checks because of the earnings test, your reported Social Security income for the year could be significantly lower than your annual benefit amount times 12, and your combined income calculation could shift accordingly, potentially in your favor if you are close to a threshold. The flip side is that some early claimers assume the withheld months mean they owe nothing on those checks, when in reality, the original amount was still earned and may still affect their overall income picture for the year, depending on how their other income stacks up. The fourth thing to check is the senior deduction stack that went into effect for 2026 and whether you are claiming all of it. If you are 65 or older, you are now eligible for the standard deduction, an additional senior deduction of $2,050 if you are single, and a brand new bonus deduction of up to $6,000 for anyone 65 and older, scheduled to be available through 2028. This bonus deduction phases out once your income crosses certain thresholds, but for early claimers who are living primarily on a reduced Social Security benefit and modest savings, there is a real chance that stacking all three of these deductions could bring your taxable income low enough to reduce or eliminate the tax on your benefits entirely. Most people filing taxes this year for the first time as Social Security recipients have no idea this new bonus deduction exists, and if they are using tax software that was not updated correctly, it may not be prompting them to claim it at all. For an early claimer with a reduced benefit and modest other income, the stacked deductions could mean the difference between having a taxable income above zero and below it, which is exactly the kind of math worth running before you hit submit. So before you file this year, check where your combined income actually lands once you include every source. Not just your Social Security check. Check whether your withholding elections from last year were calibrated for the earnings test and any IRA withdrawals you made. Check whether the earnings test affected your SSA 1099 number. And check whether you are claiming every deduction available to someone 65 or older under the updated 2026 rules, because even one missed deduction at this income level can be the difference between no tax on your benefits and a bill you did not plan for. The early claiming decision was already made, and that part is permanent, but the tax picture on top of it is not fixed. How much you owe this spring is still something you can influence before you file, and checking these four things is the place to start. If you claimed Social Security early and any of this caught you off guard, drop a comment with your age and which of these four things you are going to double check before your return goes in. And if this helped, subscribe so you do not miss the next one, because early claimers have a different tax picture than people who waited, and most of the information out there is not written for your situation.